Hello guys, welcome back to the second lesson in our financial accounting fundamentals topic. And today we're going to cover accounting ratios and interpretations. So on the left we have ChatGPT and on the right we have Grok. So I've been using like a combination of these two AIs as I mentioned in the previous videos to kind of get a better understanding of the topics, and let's dive straight into it. Lesson 2: Accounting Ratios and Interpretation. The objectives for this lesson. By the end of this lesson, you'll be able to understand what accounting ratios are and why they're important, learn how to calculate key financial ratios, interpret ratios to assess business performance and financial health, apply these ratios practically to real world scenarios. So, introduction. What are accounting ratios? Accounting ratios are tools used to evaluate the financial condition and performance of a business. They simplify financial data and help stakeholders, such as your owners, investors, and creditors, make informed decisions. Ratios are grouped into four main categories. Number one, profitability ratio. Number two, liquidity ratios. Number three, efficiency ratios. And number four, solvency ratios. Let's explore each category step by step. Profitability ratios. Profitability ratios measure how effectively a business generates profit from operations. So the key ratios. A. Gross profit margin shows how efficiently a company manages costs related to production. So the formula is a gross profit margin equals to your gross profit over your revenue times 100. So for example, if your revenue is $10,000, the cost of goods sold is $6,000, and your gross profit is $4,000, applying it to this equation above, we have $4,000 for gross profit divided by $10,000 in revenue times 100, which gives you 40%. Next is the net profit margin. So this reflects overall profitability after all expenses. The formula is as follows. Net profit margin equals to your net profit divided by your revenue times 100. So, going back to the example, if your revenue is $10,000 and your net profit is $2,000, you have $2,000 divided by $10,000, which times 100, which is 20%. Interpretation. Higher margins indicate better profitability and cost management. If margins fall, investigate rising expenses or declining sales prices. Now we move on to liquidity ratios. Liquidity ratios measures a company's ability to pay its short-term obligations. So, the key ratios. Current ratio. This is your ability to pay current or short-term loans or liabilities using your current assets. So the formula is as follows. The current ratio equals to your current assets over your current liabilities. So going on to an example. If your current assets are $8,000 and your current liabilities are $4,000, applying to the above equation, we have 8,000 divided by 4,000, which is 2.0. And then we have a quick ratio, also known as an acid test ratio. Measures the ability to cover short-term obligations without relying on inventory. So the formula is as follows. Quick ratio equals your current assets minus your inventory divided by the current liabilities. So going on to the same example as above, but this time we have an inventory sum of $3,000. Applying it to the quick ratio equation, we have 8,000, which is your current assets, minus $3,000, which is your inventory, divide by 4,000, which gives us 1.25. Interpretation. A current ratio around 2.0 or quick ratio above 1.0 is considered healthy. So going back to both of these examples, we can consider this example business as a healthy business. Lower ratios indicate potential liquidity issues, so troubles paying bills. Now we move on to efficiency ratios. Efficiency ratios measure how effectively a company uses assets or resources. So, the inventory turnover ratio. This shows how often a company sells and replaces its inventory over a period. So the formula is as follows. The inventory turnover equals cost of goods sold divided by your average inventory. All right, so going to an example. If your cost of goods sold is $50,000 and your average inventory sum is $10,000, we can find our inventory turnover by doing $50,000 of cost of goods divided by $10,000 of that average inventory, which gives 5 times a year. And then B, accounts receivable turnover ratio. So this shows how quickly customers pay their debts. The formula is as follows. Receivable turnover equals sales divided by average accounts receivable. For example, if sales gives you $100,000 and your average accounts receivable is $20,000, you can apply to this above ratio as $100,000 in sales divided by $20,000 in average accounts receivable, which also shows 5 times a year. And here's our interpretation, right? Higher inventory turnover is generally good, which results in quick sales, but too high could indicate stockouts. High accounts receivable turnover means efficient debt collection. And finally, we move on to solvency ratios. So, solvency ratios assess the company's long-term ability to meet obligations. Going on to debt to equity ratio, shows the proportion of debt versus owner's equity. So the formula is as follows. The debt to equity ratio equals to total debt divided by total equity. For example, if the total debt is $20,000 and your total equity is $40,000, applying to the above equation, we have $20,000 of total debt divided by $40,000 of total equity, which is 0.5. And then there's the interest coverage ratio. This measures the ability to pay interest on debt. The formula is as follows. Interest coverage ratio equals to EBIT, which is earnings before interest and taxes, divided by interest expense. So if your EBIT is $30,000 and your interest expense is $10,000, applying to the above ratio, we have $30,000 divided by $10,000, which results in 3.0. So what is the interpretation? A lower debt to equity indicates less financial risk. A higher interest coverage, above 2 to 3, means stronger capacity to service debt. So the next section is the interactive exercise. So testing our knowledge, right? Rejuabright, your Shopify store, has the following figures for last month: a sales revenue of $5,000, a gross profit of $3,000, a net profit of $1,500, current assets $4,000, inventory $1,000, and current liabilities of $2,000. So we have to calculate the gross profit margin, the net profit margin, current ratios, and a quick ratio. So going further down, I think ChatGPT has provided us with the solution. So it's better if you could work through that questions above and then visit these solutions to kind of see if you have an understanding of how things work. But I'm just going to quickly move down to the solutions for reasons of the video. So let's say the gross profit margin, right? So what is your gross profit margin? It is your gross profit divided by your sales revenue times 100. So in this case, it's 3,000 divided by 5,000 times 100, which is equal to 60%. What is your net profit margin? Your net profit margin is your net profit divided by your sales revenue times 100. So in this case, it is 30%. What is your current ratio? Your current ratio is your current assets divided by your current liabilities. So in this case, $4,000 divided by $2,000, which gives us a current ratio of 2.0. And then what is our quick ratio? So in this case, our quick ratio is your current assets subtracted by your inventory cost divided by your current liabilities, and our quick ratio is 1.5. So what is the interpretation from these values, right? These figures show that Rejuva is profitable, has good margins, and liquid, able to meet short-term obligations comfortably. Now, there is a section called the real world application. So investors use ratios to determine investment quality. Business owners use ratios to manage and improve operations. Banks use liquidity and solvency ratios to assess creditworthiness. Here's a quick summary and takeaway. Accounting ratios simplify financial analysis. Each ratio category provides unique insights into the profitability, the liquidity, the efficiency, and solvency of a business. Understanding these ratios equips you to make informed strategic decisions. So there's once again a few next steps we could probably do with ChatGPT. So if you want further exercises or practice scenarios, you could get that done. Have any questions or specific ratios you'd like to explore in greater depth, you can get that done. And if you're also ready, you could continue to the next topic, which is IFRS and GAAP essentials. So I think ChatGPT provides a good summary overview of what we need to understand. And now we can move on to Grok for a more analytical understanding of how these ratios work, because I find Grok provides a more analytical ratio compared to ChatGPT. So let's see what Grok has in store. Let's dive into financial accounting fundamentals, focusing on accounting ratios and interpretation. This is a key topic in CIMA syllabus, example BA3 and later F2 in professional qualification, where you learn to analyze financial statements using ratios to assess a business's performance, efficiency, and health. I'll explain the main types of ratios, how to calculate them, what they mean, using our fictional sweet rice bakery as an example. So this is the example that we had in our previous video. And if you haven't watched the video, please make sure you go watch that video after this to have a better understanding of that initial step of what financial statements are. So, what are accounting ratios? Accounting ratios are tools that turn raw numbers from financial statements like your income statement and balance sheet into meaningful insights. They help you compare performance over time against competitors or with industry standards. Think of them as a financial magnifying glass revealing strengths and weaknesses. The main categories of ratios. Number one, profitability ratios. How well does the business make profit? Number two, liquidity ratios. Can it pay its short term debts? Number three, efficiency ratios. How effectively does it use its resources? And then lastly, number four, solvency ratios. Can it handle long term obligations? Let's calculate and interpret a few key ratios using Sweet Rice Bakery's data from our earlier example. So we have an income statement with a revenue of $15,000, expenses of $9,000, and net profit of $6,000. Our balance sheet says there are assets of $15,000, which is cash in $4,000, inventory of $3,000, and equipment of $8,000. Our liabilities are $5,000, which is from a bank loan, and our equity is $10,000. So, calculating our profitability ratios. This measures how efficiently the bakery generates profits from its sales or assets. The gross profit margin, what it shows. Percentage of revenue left after cost of goods sold. In our example, we'll assume ingredients of $6,000 is the cost of goods, while wages and rent are operating expenses. So applying the formula, gross profit margin equals to revenue subtracted by the cost of goods divided by the revenue times 100. Calculation. The gross profit equals 15,000 minus 6,000, which is equal to $9,000. So the gross profit margin is equal to $9,000 divided by $15,000 and times 100, which equals to 60%. Interpretation. 60% of every dollar from sales covers the ingredients, leaving plenty for other costs and profits. A high margin suggests good pricing or cost control. For a bakery, 50 to 70% is typical, so Sweet Rice is doing well. Next is the net profit margin. What it shows. Percentage of revenue that becomes profit after all expenses. So the formula used is net profit margin equals to the net profit divided by the revenue times 100. So this gives us the calculation of $6,000, which is our net profit, divided by $15,000, which is our revenue, times 100. This equals to 40%. So what is the interpretation? 40% of sales turn into profit, a strong result. It shows Sweet Rice manages operating costs such as your wages and rent effectively. A typical bakery might aim for 10 to 20%, so this is excellent, though it's a simplified example. So next is the return on assets, ROA, what it shows. How much profit is made per dollar of assets? The formula used is ROA equals the net profit divided by the total assets times 100. So what is the calculation? We have a net profit of $6,000. Our total assets equal to $15,000 times 100, which is also 40%. So what is the interpretation of the return on assets? For every $1 of assets in cash, equipment, or inventory, the bakery earns $0.4 in profit. This is high for 1 month. Annually, businesses often target 5 to 20%. It suggests efficient asset use, but we'd need yearly data for a fuller picture. Next, we move on to liquidity ratios. These assess whether the bakery can cover short term obligations. So, for example, a current ratio, what it shows. It shows the ability to pay current liabilities with our current assets. The formula used is current ratio equals current assets divided by current liabilities. The assumption. Let's say $5,000 of loan is long term, no current liabilities specified. If we assume $1,000 of it is due within a year, then this becomes a current liability of $1,000. So what is the calculation? Our current assets equal cash of $4,000 plus inventory of $3,000. This gives us a current assets value of $7,000. So, applying the above ratio, we have we can calculate our current ratio with current assets of $7,000 divided by the current liabilities of $1,000, which gives us a ratio of 7 to 1 or 7. What is the interpretation? A ratio of 7 means sweet rice has 7 times more current assets than liabilities due soon. So that means it's a very liquid business. A ratio of 1.5 to 2 is often ideal. So this suggests low risk of cash shortages, though we are assuming minimal liabilities here. And next we have the quick ratio, also known as the acid test ratio. So what does this show? It shows the ability to pay liabilities without relying on selling inventory. So the formula used is quick ratio equals your current assets minus your inventories divided by your current liabilities. Here's the calculation. So we have current assets of $7,000, which includes our cash and inventory, minus the inventory cost, which is $3,000, which gives us $4,000, which is our cash, right? So applying this into the quick ratio, we have $4,000 for current assets minus inventory divided by $1,000 for our current liabilities, which gives us a ratio of 4 to 1. So what is the interpretation? Even without inventory, sweet rice has 4 times the cash to cover short-term debts. A ratio above 1 is solid, so this is a strong position. Next, we move on to efficiency ratios. These show how well the bakery uses its resources. So, inventory turnover, what it shows. How often inventory is sold and replaced in a period. So the formula used is inventory turnover equals cost of goods divided by average inventory. So the assumption in this example, let's say inventory was $2,000 at the start of April. So the average inventory equals $2,000 plus $3,000 divided by 2, which gives us $2,500. So going back to the calculation, our cost of goods sold is $6,000 divided by our average inventory cost of $2,500 calculated here equals to 2.4. So what is this interpretation? The bakery sells out its inventory 2.4 times per month, which is pretty fast for a bakery. High turnover means efficient stock management, reducing waste, example, stale bread. A bakery might aim for 10 to 20 annually. So this aligns, which is 2.4 times 12 equals about 29 times annually. Next, we move on to solvency ratios. These evaluate long-term financial stability. Step 1. The debt to equity ratio. What it shows. How much debt finances the business compared to owner's equity? The formula used is debt to equity equals total liabilities or divided by equity. So the calculation goes as $5,000 of total liabilities divided by $10,000 in equity, which is 0.5. What is this interpretation? For every $1 of equity, there is $0.5 of debt, which is low average. A ratio below 1 is conservative, meaning Sweet Rice relies more on owner funds than loans, reducing risk. Interpreting Sweet Rice Bakery's performance. Profitability, high margins, 60% gross, 40% net, and ROA of 40% suggests strong earnings and asset use. Liquidity, current 7 to 1 and quick ratio of 4 to 1. Ratios shows it can easily cover short-term debts. Efficiency, inventory turnover 2.4 times a month, good for a bakery with perishable goods. Solvency, debt to equity of 0.5 indicates low reliance on debt and therefore a safe position. Overall, Sweet Rice is profitable, liquid, efficient, and stable, a healthy business. But in real life, we'd compare these to industry benchmarks or past months for context. So once again, Grok also has a few more things that it can teach us. So it breaks it down into a practice, deeper dive, or CIMA context. So in practice, it says, want to try calculating ratios with new numbers? I can tweak Sweet Rice's data, example, add more debt or lower sales and guide you through. And deeper dive covers curious about a specific ratio, example, how depreciation affects ROA. I'll explain. And you can also get answers in a CIMA context where Grok can link this to exam style questions like interpreting a company's ratios to recommend actions. So I think this is a good point to stop for today's video, and I hope you guys understood or have a good understanding of how ratios work and what the use is for these ratios. So what I'm going to do is I will PDF the ChatGPT and the Grok lessons and probably link it to the video. But yeah, so I will be back with a new video with the next topic under accounting fundamentals, which is IFRS and GAAP essentials. So like and subscribe and catch you guys in the next video.